Imagine depositing your life savings in a bank. You assume the money is safe. But what if the bank has lent too much, borrowed recklessly, or cannot meet sudden withdrawals? The 2008 global financial crisis exposed exactly this danger. Some of the world's largest banks appeared profitable on paper but lacked sufficient capital and liquidity to survive shocks. The result was Basel III, a global regulatory framework developed by the Basel Committee on Banking Supervision to make banks more resilient. At its heart, Basel III asks a simple question: can a bank survive both losses and panic? To answer this, it strengthens two pillars of banking stability, that is, the capital adequacy and liquidity management. Capital is the bank's own financial cushion that absorbs losses before depositors are affected. The most important requirement is the Common Equity Tier 1 ratio, consisting mainly of equity shares and retained earnings. Under Basel III, banks must maintain a minimum Common Equity Tier 1 ratio of 4.5% of their risk-weighted assets. In addition, banks must maintain Tier 1 capital of at least 6% and total capital, that is Tier 1 plus Tier 2, of at least 8% of risk-weighted assets. But regulators recognized that crises often occur after periods of excessive optimism. Therefore, Basel III introduced the Capital Conversion Buffer (CCB) of 2.5%, bringing the effective total capital requirement to 10.5% for most banks. Pause and think about this. The best time to prepare for a financial crisis is when everyone believes one is impossible. Basel III also introduced the counter-cyclical capital buffer, allowing regulators to require additional capital during credit booms to prevent excessive risk-taking. For globally significant banks, additional capital surcharges may apply because their failure could threaten the entire financial system. A bank may be solvent yet fail if it cannot meet immediate withdrawal demands. Therefore, Basel III introduced robust liquidity standards. The first is the Liquidity Coverage Ratio (LCR). Banks must hold enough high quality liquid assets such as cash and government securities to survive a severe 30-day stress scenario. In simple terms, LCR ensures that banks can handle short term panic without depending on emergency assistance. The second is the Net Stable Funding Ratio. It requires banks to maintain stable long term funding relative to their assets over a 1 year horizon. A memorable way to understand this is LCR helps a bank survive the next month, while Net Stable Funding Ratio helps it survive the next year. Basel III also introduced a leverage ratio generally set at a minimum of 3% to limit excessive borrowing regardless of risk weight calculations. This is important because sophisticated risk models sometimes underestimate actual risks. The leverage ratio acts as a simple backstop against balance sheet expansion. The framework further strengthens risk governance, stress testing, disclosure requirements, and supervision of systematically important institutions. In India, the Reserve Bank of India has implemented Basel III norms with certain adaptations. Indian banks generally maintain capital levels above minimum requirements, enhancing resilience against global financial shocks. The framework gained renewed importance after episodes such as global banking stress of 2023, demonstrating that strong regulation remains essential even in advanced financial systems. To conclude, Basel III is more than a technical banking framework. It is the financial system's insurance policy against instability. Its core philosophy is simple yet profound. Banks should build strength during good times so that society is protected during bad times. Because in modern economies, banking stability is not merely a financial objective. It is the foundation upon which growth, investment, and public trust ultimately rest.